Greetings, and welcome to the High Flying Tutors Academy channel. Today I'll be helping you about cash flow statement, how to prepare the cash flow statement. So here is the question. So without any waste of time, let's just go through the question, and then I've also prepared an answer sheet on how we are going to answer this question. So this is the answer sheet. This is where we are going to do our or record our answers after doing calculations, right? So there's quite enough detailed answer sheet that we are going to use to prepare this cash flow, right? So right now I was just showing you the answer sheet, but I want us to go and go through the question paper, and then we'll come and record all the calculations in this answer sheet after going through the question paper and doing calculations, right? So let's go through the question paper first, because that is the first approach. Even in the exam, whether in the test, you go through the question paper, you understand what is required of you, you get to understand what is it that you need to calculate, what is it that is missing, what is it that you just have to copy and paste, and all of that. So let's go to the question paper quickly and see what is the information provided about this cash flow. Okay, we are doing question 1, A Limited statement of financial position provided as at 28 February 2018. They gave us there. So in the test, you just have to browse through. You are given ordinary share capital, retained earnings, long-term loan, and all of that, right? So you need to make sure that you go all through this information so that you've got an idea of in the picture of what is it that you are going to do and what is it that is required to do in the cash flow statement, right? So we are also provided with a statement of profit or loss and other comprehensive income for the year ended 28 February 2018. And there is the information for the statement of profit or loss. They provided with us with revenue, cost of sales, gross profit, and all those other items right there. I don't want to read everything. You guys can see this. And then additional information, they provided us with the PPE, the property, plant, and equipment. Summary of the property, plant, and equipment. We have got machinery, carrying amount, the cost, and the accumulated depreciation, right? And then they also provided us with the additional information or transactions that took place. Transaction number 2, they say plant and machinery with a carrying amount of 1,000, cost price 8,000 was sold for 500 and was replaced with a new one on the 28th of February 2018. Cash paid to suppliers. Transaction number 3, cash paid to suppliers and employees amounted to 40,050. Ordinary dividends amounting to 6,000 were declared during the year. Included in the administrative expenses are the following disclosable items. Let's see what are those disclosable items that are in the administrative expenses. We've got loss on sale of plant and machinery. We've got audit fees. We've got director's remuneration, depreciation. And then required part. Remember, I said you need to check as well what is it that you are required to prepare. As I said, we are going to prepare the cash flow. Here is the required part where they say prepare the statement of cash flows of Toll Limited with notes for the year ended 28 February 2018 in compliance with the requirements of the Companies Act 71 of 2008 and International Financial Reporting Standard. Then they say ignore comparative figures but show all the calculations. All right, so let's see how we are going to prepare this cash flow. Number 1, in the cash flow statement, if we were to go to our answer sheet right there, or remember, cash flow is divided into 3 activities, which is going to be cash flow from operating activities, 1. 2, cash flow from investing activities, 3, cash flow from financing activities, right? So we're going to do that. So now, under cash flow from operating activities, we need to first consider cash receipts from customers, right? Cash receipts from customers. So let's go to our answer sheet right there. We are going to say number 1, under cash flow from operating activities, number 1 item is cash received from customers or clients, right? Okay, so this cash received from customers, as we went through our information in the question paper, it is not granted or given. So how do we calculate that? We need to calculate it because it is not provided in this question. When we check there, it is not provided, but there is items and information on how to calculate the cash receipts or received from customers. So let's go and see how to calculate. Number 1, for you to be able to calculate, you must know the items that you need to calculate the cash received from customers. Number 1, you're going to need the revenue or sales. So let's go to our calculations right here. Calculations, cash received from customers. Number 1, you're going to need your sales or revenue. Sales or revenue. Right? That's the number 1 item that you need. All right. And then number 2 item, you are going to need change in debtors. Change in debtors. Right? Change in debtors. So you change in debtors, I'm going to encourage you to check whether it's an increase or decrease, and just to be specific whether there's an increase in debtors or there's a decrease in debtors. Are you with me? So where are you going to check? We are going to check this in the provided financial position. Financial position, debtors is given right there. So your debtors, as you check right there, your debtors that is provided here, it's what? You check whether it's an increase from the previous year to the current year. If there's a change and the change in debtors is an increase, then you know that you have to say to determine whether it's an inflow or outflow. So an increase in debtors is an outflow. An increase in debtors is an outflow, and a decrease in debtors is an inflow. So when the debtors come to you to purchase, when you sell to them, they are decreasing the cash from the business, right? Because you are making a sale. And then they're not paying anything, but when they come to pay, they're going to decrease what they are owing to you. So you are going to be receiving money. Therefore, when you receive money, they will be decreasing. If your debtors were owing you 10,000, they pay 5,000. There's a decrease of debtors of 5,000. Therefore, you are receiving money. That is why it's an inflow. It's an inflow, a decrease in debtors, inflow, right? So a decrease in debt, and I mean an increase in debtors. Why are we decreasing it? Why are we subtracting it? It is included in the revenue and it's not cash. People just came and borrowed and you didn't receive anything. So we cannot even consider them. That's why we have to decrease them. I don't know if I make sense right there. An increase in debtors, we subtract it. It's not like there was any cash inflow or anything. We're just subtracting it because it does not qualify to be in the cash flow, because they just came and borrowed stock or borrow whatsoever you are selling or whatsoever service you are selling, and then there was no any cash transaction. And remember, in our revenue or in our sales, it's included because when you sell on credit, it's still part of the sales, but there was no cash. Therefore, we have to remove it from sales, that increase in debtors, because it is not a cash item. Just to clarify why we are subtracting an increase in debtors. A decrease in debtors is when your debtors are now paying cash from what they borrowed from you, from the money they are owing you. They are paying. When they pay, they are decreasing and you are receiving money. Therefore, a decrease in debtors is inflow, money in. Therefore, it qualifies to be money received from customers. I hope you got that one, right? So let's go and calculate. And then those are the main items that you need to check. But you can also check if you received the money in advance, where they might be an income received in advance. And you have to check if you've got any rent income. Maybe you've got tenants that are paying to you. It's also that money from rent income can be considered to be cash received from customers. Just to explain this item on how to calculate the cash received from customers. But here the main thing is that there's an increase in debtors. There's an increase in debtors. There is an increase in debtors. There is an increase in debtors. So an increase in debtors is an outflow, right? So let's go and check how much is our revenue or our sales from this. Sales, our sales there is 60,000. Our sales is 60,000. So we are just going to put that 60,000 in our calculation there. 60,000. All right, and then we are going to take out increase in our data. So our increase in data, so we're just going to check from the previous year to the current year, right? So when you check right there, your data in the current year increased from the previous year from 14,500 to 19,000 rand. Okay, so it means you go into your calculation, in bracket you say 19,000, you minus 14,500, right? In bracket right there. And then how much are you getting? Let's just put that on the calculator. Let's just put that on the calculator. 19,000 minus 14,500. All right, I'm getting an increase of 4,500, right? That is your increase or change in data, which is an outflow, right? We call it an outflow, but we are subtracting it because it is there in the sales and it's not cash item, because there was no cash transaction that took place, but we made a sale on credit. Therefore, it is included in the sales. We are taking it out. I repeat this. And then if it's a decrease is when the debtors are paying what they are owing. Therefore, there's a cash transaction. You are receiving money. Therefore, a decrease in debtors qualifies to be added to the sales because it increases your cash received from customers. Because when you receive money from your debtors, they are also your customers. I hope you got that one right. So now let's calculate how much is our cash received from customers. You're just going to say 60,000, you less 4,500, and then your cash received from customers is 55,500. That is your cash received from customers. Cash received from customers. Cash received from customers. Cash received from customers right there. And then this cash received from customers of 55,000, 500. You're gonna put it in our cash flow up there, right? In the operating activities right there. So our cash receipt from customers is 55,500. Then we are sorted right there. And then the following item here is going to be a cash paid to suppliers and employees. Remember, the explanations that I give can be different from other people or can be different from other tutors, or other people that teach accounting, but I have my way of understanding and explaining. So as long as you understand better the way I do it, that's fine. If you understand the other tutor or the other YouTube channel, no problem. All right, so now remember, cash paid to suppliers and employees, right? This is an outflow because you are making a payment, money out of the business, cash outflow, right? It's an outflow. So definitely it's going to be in brackets, and it is provided in our additional information right there. Let's go and see how much is it. Let's go and see how much is it, okay? Transaction number 3, cash paid to suppliers and employees is 40,050, right? 40,050. All right, so we're just gonna go to it's a copy and paste this one, right? Copy and paste, but it's an outflow. You put in brackets. Remember, in accounting, whatsoever we minus or whatsoever we make a payment for must be in brackets, right? And then now we put in brackets, and this is going to allow us to calculate what our cash generated from operations. So our cash generated from operations is going to be our cash received from customers less our cash paid to suppliers, and then we are going to get our cash generated from operations. So let's calculate our cash generated from operations. We put that on the calculator. It's going to be 55,500, our cash received from customers. We subtract 40,050. I am getting 15,450. That is our cash generated from operations for 15,450. All right, and then now we are done with that other part, but we've got other items that we must include in the cash flow from operating activities. Those items, as I look at in the question paper, let's just go and look for them. Number 1 that I've seen, because remember, it is important for you to go through the question paper before you start writing, so that you figure out what is it that you have. So the items you have here, we've got finance charges or interest, number 1, from the statement of profit or loss. So we're going to take that, or the other term for it is finance cost. So you can just come here and say finance charges or finance cost. So finance costs, remember, finance costs are interest paid or finance charges, right? So it is given. You don't have to calculate it anyhow. You don't have to calculate it. It is given. We're just gonna check how much is it in the question paper and copy and paste. So it is 950. That's what you paid in terms of interest. That's what you paid. So it's going to be an outflow. You put in brackets 950, close brackets right there. So fine. And then the other item that is provided according to me and that you need to do calculation for is dividends paid. Dividends paid. You need to do dividends paid. Dividends paid. Dividends paid. So your dividends paid, you open brackets right there, and then you do the calculations. How do you calculate dividends paid? You are going straight to the statement of financial position. Let's go up there. Statement of financial position. And then you're going to look for shareholders for dividends. So for you to calculate the dividends paid, you're going to say shareholders for dividends at the beginning, which is here, 4,000 rand, right? 4,000 rand. Let's go to our answer sheet. 4,000, right? And then you plus or you add dividends declared during the year. Dividends declared during the. So let's go and look for dividends declared. Dividends declared, I believe it is in the additional information down there. Ordinary transaction number 4, ordinary dividends amounting to 6,000 were declared during the year. So you add it to the 6,000. You go to your answer sheet, you say plus 6,000, and then you minus shareholders for dividends at the end. Shareholders for dividends at the end, right? So shareholders for dividends at the end is in the financial position up there. Let's go and check that one. It's 6,000, right? So shareholders for dividends at the end, which is the current year of 2018, it is 6,000, right? So you go and pick this 6,000 at the end of the year, you put it in the calculation right there, minus 6,000. You close brackets. So let's do the calculation right there quickly. So it's gonna be 4,000 plus 6,000 minus 6,000. So I am getting an outflow of 4,000 rand, because any payment you make, it's an outflow. So we have got an outflow of 4,000 rand. Okay, then you put in brackets because it's an outflow. But inflows, you don't put in brackets. Like cash received from customers is an inflow, we don't put brackets right there, right? Like cash generated from operations is an inflow, we didn't put brackets right there. So I hope you guys are following, all right? And then now let's go and calculate our taxation paid. That is another item that I saw that we need to calculate, and that is the last item. The other items for this in this question, they're not provided, so we're not going to focus on them. But in the next question, I'll offer you a better question that include some other stuff that must be considered when you are calculating cash flow from operating activities. So now taxation paid. So taxation paid, if you were to calculate taxation paid, you are going to look at the SARS in the statement of financial position. We don't have any SARS here, but in the statement of profit or loss, we've got SA normal tax. So we had to pay SARS 6,000, and since there is no display of this in the statement of financial position, that means we are not owing SARS anything. It means we've paid this 6,000 to SARS. That's what we paid. So we're just going to copy this 6,000 and paste to the statement of cash flow. So let's just go there. And then because we are making a payment of, or we made a payment of SARS to SARS of tax, we're just going to say 6,000 right there. And then we are done. Right, these are the items that were included for us to calculate cash flow from operating activities. So now we need to calculate the cash operating activities. For us to calculate that, we are going to do the calculation from cash generated from operations. So we are going to say cash generated from operations, which is going to be 15,450 minus 950 minus 4,000 minus 6,000. I am getting a positive amount or a cash inflow of cash flow from operating activities of 4,500. That is your cash flow from operating activities, right? So we are done with the cash flow from operating activities. We need to go and do the cash flow from investing activities. Simple one, right? Very simple. I know most of the time people struggle with cash flow from investing activities. So for you to understand this cash flow from investing activities better, you need to ask yourself, what do business invest in itself with? So it invests in itself with the non-current assets. Because remember, the non-current assets are there for a longer period in the business. They are there for a longer period in the business to help the business to operate and generate income. So we're going to focus on that. So let's go and check in our question. What is it that we have that are related to our our non-current assets? All right. So now, let's see what is happening right there. We're going to the question. All right, so let's just go there. All right. Let's see. We have got a machinery, right? Let's go and check again in the statement of financial position. So we only have plant and machinery, right? So we need to go and prepare what? The machinery account, right? The machinery account. We need to prepare the machinery account, one. Let's go and prepare the machinery account to determine whether we've got an increase in machinery. So we are going to our answer sheet right there. Let's go down there to the calculations. Already prepared this for you. So we're just gonna say machinery. Machinery account, all right. Machinery account, let's see, I just want to fix this. All right. Machinery account. Let's see. All right, and then remember, machinery. Machinery. It's you can say plant and machinery, no problem. Machinery, it's an asset and it increases on the debit side. So we are going to start with the opening balance. Right, on the folio, balance brought down, which is the opening balance, right? And then the amount. And then we must also have our closing balance carried down, right? And then let's go and determine these two items first. Number one, we're going to get this from that additional information in the PPE, or property, plant and equipment. If you check, we're going to look at the cost price, right? Cost price, not the carrying amount, not the accumulated depreciation, but the cost price. So the cost price of machinery or plant and machinery at the beginning is 18,000. Right at the beginning is the previous year, because remember, closing balance of the previous year will be an opening for the current year. So we've got 18,000, and then our closing amount, according to the question, how much do we have? 16,000. All right, so we come this side, we say we've got 16,000, and then we have determined the opening and the closing. And then let's go to transaction number one, because there's an additional information on transaction number two. I mean to say. Transaction number 2, they say plant and machinery with a carrying amount of 1,000 that cost 8,000 was sold for 500 and was replaced with a new one on the 28th of February 2018. So fine. So now you go back to our answer sheet. There you are going to say there's an asset that was disposed. So you're going to say asset disposal there. Asset disposal, because when they sell the asset, it means they are disposing it, they're taking it out of the business, right? So we need to account for it, because whenever asset decreases, remember we credit. So we go to the credit side of this and say asset disposal, right? Asset disposal right there. And then we record the cost of 8,000 because they say they sold that machine that costed us 8,000 when we purchase it. So we decrease it at its own cost. Even when we add the asset, we add it at its own cost price, right? So now, after this, do we have any transaction about machinery? Let's see. It's only this, right? But they say there's a new machine that was purchased to replace the old one that was sold. Right? So let's go and see what is happening right there. So now we are going to go to the debit side and calculate and balance the side, because if you check, the bigger side here is the credit side. So we're going to say 8,000 plus 16,000. How much are you getting right there? Just to balance and determine the new cost price for the new machine. So it's going to be 8,000 plus 16,000. So I'm getting 24,000. So here, total 24,000. Even on the other side, our total or our balance is 24,000. All right. And then you're going to say 24,000 minus 18,000. You are going to get the new price or the cost price of the new machine. Then you're going to say bank. And then 24,000 less 18,000, I get 6,000. That means we sold a machine that cost 8,000 and we replaced it with a machine that cost 6,000. I hope you guys are still following. And then this 6,000 is the one that is going to go to the cash flow. All right? It's going to the cash flow as a replacement of plant and machinery because they replaced. So you're going to say, you're going to go to the cash flow under investing activities and say proceed from sales of plant and machinery, right? All right, so let's go and prepare another account. Another account that we must prepare is accumulated depreciation on a machinery. Right? Or on plant and machinery. That's the second account we need to prepare. All right, so let's go and prepare that. Accumulated depreciation on machinery. Just want to make sure things are in order here. All right. And then we are going to prepare this. Remember, the accumulated depreciation account, right? It's an account that decreases an asset. So it will definitely decrease where asset increases and increase where asset, it will decrease where asset increases and increase where asset decreases. I don't know if I make sense, right? So now, the opening balance of this account is going to be on the credit side because remember, I say it will increase where asset decreases. and decrease where asset increases. So we are going to increase it on the credit side. So it's going to be balance brought down right there. So which is opening balance, and we also have to determine the balance carried down, which is the closing balance right there. Okay. And okay, sorry. And then here, remember, we have to also disclose maybe the balance at the end, which is going to be an opening balance of the following period, which is going to be 16,000, because remember, closing balance of the previous year must be an opening for the current year. So fine, I just wanted to clarify that one in this account, right? Because remember, when I do these questions, I do them from scratch. I don't do them looking at the memo or anything. I just prepare, right? So if I make mistakes there and there, no problem. We still get it right. I'll still go back and fix if I see it. If I don't see it, you guys put on the comment to indicate there's an issue there, and then we fix. Okay, so let's proceed. Yeah, I do this question from my mind. Okay, so please, if you see any errors, please notify me on the comment. I'll clarify that, but I don't do mistakes. I know what I'm doing. Okay, so now let's proceed. So we need to determine the accumulated depreciation on machinery. All right, so number one, we're gonna check the opening balance of the accumulated depreciation. Where are we going to get this? In the question, additional information in the property, plant and equipment. So accumulated depreciation, opening balance 8,000, right? Opening balance 8,000. So let's go to the answer sheet there and put this here, 8,000. All right, and then closing balance. Let's see how much is our closing balance in the question there. It's 3,000, right? So fine, let's go to the answer sheet right there. We put 3,000. Okay, and then we also have to record the accumulated depreciation of the asset disposal this side. All right, and then we also have to record on this side depreciation. Just giving you the format quickly. If you've got any questions, that put on the charts where I need to explain a lot, or I feel like this needed a better or proper explanation, I'll do it. But I believe this one you understand it better, right? So depreciation, it was given in the additional information. Depreciation was provided right there. Transaction number 5, depreciation, there we go. Here, right, 2,000. So you take that 2,000, you put it right there, 2,000. All right. And then now we are done with this account. We just need to close it off because there's no any other accumulated depreciation on machinery or whatsoever, right? So we are done here. So we are just going to add the 2. So 8,000 plus 2,000 is going to give you a total of 10,000. Okay, 10,000 right there. And then 10,000 minus 3,000 will give us 7,000. So that 7,000 is our accumulated depreciation for the asset disposed. For the asset disposed. I don't know if you get my point right there. And then we will have a closing balance there, which is going to be an opening. So we're going to put it there, balance brought down of 3,000, which is this 3,000, right? But remember, there is nothing that we are going to record in the cash flow from the accumulated depreciation because there is no cash involved here. Depreciation is a non-cash item, so it cannot qualify to go to our cash flow, right? And then after that, we have to prepare what? Our asset disposal account. So I have got another account right down there. We need to prepare our asset disposal account. Remember, for the purpose of preparing an asset disposal account is to determine our what is this? To determine our proceed from sales of an asset or of a machinery now, because we're dealing with machinery. So let's see. Even though in this question is provided, but for the sake of getting more marks, indicate how you can arrive on that stage, right? Asset disposal, because I saw this question, I looked at it, I said, oh, these other things are provided, but I'm going to do another one so that you guys can understand what we're doing here. All right. So this is a simple question that most of the staff were provided. So in the asset disposal, they say, remember, you sold a machinery, right? So you come here and say machinery. All right, machinery. The machine that you sold, you need the cost price there. You need to put the cost price of the machine you've sold. So let's go to our additional information or our question. Our question, additional information number 2, plant and machinery with a carrying amount of 1,000, cost 8,000 was sold. So we need the cost 8,000, and this 8,000 also you can take it from the asset account, which is machinery account up there. You just do the double entry system or duality principle can be applied on this question, where you're going to take this and take it to the asset disposal of 8,000. All right. And then you come this side, you will have what we call accumulated depreciation. Accumulated depreciation of the machine sold. You are going to the accumulated depreciation account, 7,000, right? So you put it there, that's 7,000, double entry system or duality principle. I hope you guys are following right there. And then after that, you go and determine whether you've got a profit or a loss and the bank. So remember, when I check in the additional information, let's just go there. In our additional information, they already gave us how much is the bank, because they said we was sold for 500. So we received this 500 when we sell. Already we've got a proceeds, yes, given. But for the sake of marks in the calculation, we have to just to do our calculations. So let's go and record this 500 in the asset disposal account. Right. Let's go there. Bank. We come this side and say bank. We already have this, but most of the time they don't give you. They need you to calculate it, but here it's given, right? 500. All right, 500 is given for the bank. All right, so we are fine. And then we check now. We need to determine whether we made a loss or a profit, but it is given also. The loss is given. The loss is given, but let's just see. It's going to be, the bigger side is the debit side here. So it's going to be 8,000 right there. And then even this side is going to be 8,000. All right. And then 8,000 minus 500 minus 7,000, or 800 minus 7,000 minus 500 is going to give you a loss on sales of an asset, right? So it's going to be loss. So your loss, you have to check if the bigger side is the debit side. You're going to record the difference loss on sale. Loss on sale on the credit side of how much? 8,000 minus 500 minus 7,000. I'm getting 500, and it's given in the additional information, if I remember correctly. Let's just go and double check that. So in this question, most of the things were given. So it's an easy question to do. I'm going to do a difficult one. This one is a warm-up, okay? So they say loss on sale of plant and machinery 500, and we got that one, right? So we are sorted. But remember, we are going to record this bank as a proceeds from sales of an asset. This goes to the cash flow, right? Under investing activities. Unfortunately, we don't have a lot of non-current assets or investing items that we need to do. It was just this machinery. So let's go and record this. Remember, number one, we have to record a replacement of machinery. This one, 6,000. So let's just go to our cash flow up there. Our cash flow up there. Which is we're gonna start by we're gonna start by what is this? Replacement, right? Replacement. A replacement of plants and machinery. All right, remember when we replace it means we're buying cash, right? So 6,000. Remember that 6,000 from the machinery account or plant and machinery account, right? And then we also have what? An amount from there. This 6,000 is the one that we recorded there as a replacement, right? And then we also have to record proceeds from sales of plant and machinery, which is 500 that we received when we sell that plant and machinery. So according to transaction number 2, if you remember. All right, so we are going to say proceeds. Remember, replacement outflow, proceeds inflow. So proceeds from sales of plant and machinery. All right. Then that 500, we take it from there as a disposal. And we don't have any asset. We don't have any asset. We don't have any asset. It's just only machinery where we had to replace to sell the old one and replace it with a new one. We are done, right? So now we have how much there? Just gonna be negative 6,000 plus 500, of which is going to give us outflow of cash flow from investing activities of 5,000. Just put that on the calculator. 5,500. 5,500. That is your cash flow from investing activities. All right, cash flow from investing activities. And then we are done with cash flow from investing activities. And then we are going to financing activities, cash flow from financing activities. Now, when you come to the cash flow from financing activities, you need to ask yourself, right? How do business finance themselves when they don't have cash? One, they sell shares or they issue shares. Number two, they go to borrow money, so loan. So you're going to focus on those shares and loan. That's what you're going to focus on, right? So let's start with the shares. Let's start with the shares. Let's go to our question. So our shares is not, there's no additional information about shares here. So we are going to the statement of financial position. statement of financial position. Statement of financial position. So in the statement of financial position, we're going to look at what? Ordinary shares. To check from the previous year to the current year, is there an increase or decrease? If it's an increase, they issue the shares. If there's a decrease, they sold the shares, right? So now, this is an increase, therefore they sold the shares and they received the money, right? So an increase in ordinary share capital is an inflow. So we're just going to calculate the difference, right? So the difference, we can just go in our cash flow and say proceeds from issue of shares. Proceeds from issue of shares, right? Or proceed from issue of ordinary shares. And then you can also indicate in brackets the calculation right there, no problem. Let's see. So we are going to say 16,000 minus 10,000, right? Is the only shares that I see. So we're just going to deal with that. 16,000 minus 10,000. So let's go to our answer sheet and do the calculation. 16,000 minus 10,000. All right. And then 16,000 minus 10,000 is going to give us 6,000 inflow. That is an increase in shares. It's going to give us 6,000. All right. And then we are going to check the loan. Let's go and check the loan. Let's go and check the loan in the additional information. I mean, in our question, our loan is up right there. So if you check, we were owing a loan of 11,000 from the previous year, and currently we are owing 8,000. That means there was a repayment of loan. So you go to your cash flow answer sheet right there. You're gonna say repayment or payment of loan. Repayment or payment of loan. Repayment of long-term loan or loan. All right. Repayment of long-term loan or loan. And then the difference, you can also indicate you had 11,000 minus 8,000 because there's a decrease in loan. There's a decrease in loan. There's a decrease in loan, and then how much is the decrease? How much did you pay for your loan? 3,000. All right, 3,000. All right, so that is your financing activities. There is no any other information about financing activities. Close brackets, because when you make a payment to the loan, money outflow. All right, money outflow. And then you're gonna say 6,000 minus 3,000. You're gonna get an inflow of 3,000 right there on the cash flow from financing activities. 3,000. All right, fine. Now we need to check this one. I'm not going to say it's a net decrease or increase. We'll check if it's just a net. Either it's going to be an increase or decrease. So I'm not going to say it's an increase or decrease. That one it was just another question that I was doing. But now we are going to check, right? So for you to calculate net to determine whether there's an increase or decrease of cash and cash equivalents, we are going to say cash flow from operating activities. Let's just do that calculation. Is going to be 4,500. you less your cash flow from investing activities because there are outflows, and then you add your cash flow from financing activities of 3,000. So I am getting a net increase. So this is a net increase. A net increase in cash and cash equivalent of 2,000. 2,000, right? All right. 2,000. Okay. So now we need to determine the cash and cash equivalent at the beginning, and it must correspond. So now, when we determine, let's go to our question. We're going to check this in our financial position. So in our financial position or statement of financial position, we have got at the beginning, we've got our bank overdraft at the beginning of 500. So our bank overdraft is our cash and cash equivalent at the beginning of 500. So we're gonna go to our cash flow and open brackets 500, close, and then we go to cash and cash equivalents at the end. Cash and cash equivalent at the end, we're looking at the cash bank, the cash in bank of 1,500, right? 1,500. 1,500. All right. And then if you check this, 2,000 minus 500 is giving us 1,500, which is cash in bank at the end. That means our cash flow is fine. Or if we're going to say 1,500 plus this 500, we're getting 2,000. That means our cash flow is balancing. Everything is sorted. Everything is fine, right? So we are happy with our cash flow. Now, we are left with what? We are left with the cash, with the reconciliation of profit before tax with the cash generated by operations or cash generated from operations. Cash generated from operations. All right. So now here, number one, we determine what? Our profit before tax or profit before taxation. So profit before tax, we're gonna go to our additional information and check how much is our profit before tax. Our profit before tax right there is 15,000, right? It's 15,000. So you take that 15,000, just copy and paste because it's our note. So copy and paste because they requested us to prepare this note. So 15,000. All right. And then adjustment for we need to adjust for finance cost, and we need to also adjust for let's see, depreciation. Remember, depreciation, and we need to adjust for loss on sale of plant and machinery. Plants and machinery. Plant and loss. So these items are going to be subtracted when we adjust, because remember, they are already, remember, depreciation is a non-cash item. Loss on sale of plant is also a non-cash item. Finance cost, this information is already included in the profit before taxation. That is why we add them back, because they need to be considered. We need to adjust them from the profit before taxation in order for us to calculate for operating profit before changes in working capital. So we're going to add all these expenses, right? We're going to add them. So because we are going to adjust for finance costs. So if we had incomes, like if we had investment income or rent or interest received, or maybe we had a profit on sale, we're going to subtract, right? So incomes here, you subtract. Expenses that you need to consider here, you add. So finance cost, we are just going to copy and paste from the statement of profit or loss is given. How much is it right there? What is it? 950, right? There we go. So we're gonna come here and add 950, and then depreciation also we calculated for it. No, it's given as well. It was given, but you usually will go and take it from the additional the calculation we did on the T accounts down there, which is going to be how much under. So it's 2000. We're going to take this 2000 is going to our note, which is the reconciliation of profit before tax with cash generated. All right, and then we get here depreciation 2000, we add, and then loss on sale of plant and machinery, it was also provided. Remember, we got it was 5000, right? I mean 500, not 5000, just provided right there. Transaction number 5, loss on sale of plant and machinery 500. So we're just going to take that and put it right there, 500. So now we are done with this. All right, so for adjustment for non-cash items or adjustment for, we are done right there. So it's going to be 15,000 plus finance costs plus depreciation plus loss on sale of plant and machinery. We are going to get our operating profit before changes in working capital. Changes in working capital, right? So we're just going to add everything. So let's do that calculation quickly. So it's going to be 15,000 plus 950 plus 500. So I'm getting 16,450, right? When I say okay plus 2,000 for depreciation, I'm getting 18,450, right? You have to say 15,000 plus 950 plus 2,000 of the depreciation plus 500 of the loss on sale of plant and machinery, and then I'm getting 18,000. I'm getting an operating profit before changes in working capital of 18,450. All right, and then that is our operating profit before changes in working capital. And remember, cash generated from operations, right? Cash generated from operations, you can still take the one from the cash flow up there, because it must be the same, right? You can take that one, it's 15,450, but we are going to see if it's going to be correct as well. So it's going to be 15,450, just to save time, okay? Because remember, in the test or in the exam, you are also chasing time. All right, and then now the things that we must consider is going to be change in inventory, change in our debtors, and change in our creditors. So let's start with the inventory. Change in our inventory, we're going to determine whether it's an increase or decrease, and we're going to check that from our financial position. So when you check right there, there is a decrease in our inventory, right? There is a decrease in our inventory, right? From 18,000 to 16,000. So there is a decrease. A decrease in inventory is an inflow, because it means we sold more inventory, and the difference we received more money, right? So you go to you go to your answer sheet right there and say decrease in inventory or decrease in trading inventory. Decrease in inventory. Decrease in inventory, which is how much? Let's see. Let's just double check that. 18,000 minus 16,000. The difference there is 2,000, right? So you're just going to do that. 18,000 minus 16,000. Okay, and then it's an inflow because it means we sold more inventory. Therefore, an increase in inventory is an outflow. But this one is an inflow of 2,000 rand. All right, then we are done with this one, and then we go and check our debtors. Our debtors, remember, it's an increase. Again, our debtors, it's an increase in debtors. Right? An increase in debtors, an increase in debtors, remember, it's an outflow considered to be. Right? So we are going to take the one that we calculated down there on the calculations, right? 19,000 minus 14,500. So let's just do that. 19,000 less 14,500, close brackets, and then how much are you getting there is the same amount of 4,500, but outflow, considered to be an outflow, right? And then we are done with that one. Then we go and check our creditors. Our creditors, if you check our creditors, let's go and check in our information right there, or in our question paper. Our creditors, if you check our creditors, there's a decrease from 15,000 to 14,500. A decrease in creditors is an outflow. It means, remember, creditors are liabilities, are people that you are owing. So if they decrease, it means you paid them. Therefore, cash outflow. It's an outflow, right? It's an outflow, money out. So you're just gonna come here and say a decrease in creditors. Decrease in creditors. You open brackets right there. You say 15,000 minus 14,500. Do the calculation there, but you can see it's just 500, outflow of 500, outflow of 500, you close bracket. So now let's check if this thing is the right. All right, so we are going to say, let's calculate our cash generated from operations by saying operating profit before changes in working capital of 18,450. You add 2,000, which is the decrease in inventory. You less 4,500 increase in debtors. You also less decrease in creditors, which is 500. And we are getting 15,450, which is the same as the cash generated from operations in the cash flow, in the main cash flow. So they must always be the same. If they are not the same, something is wrong. So you need to make sure that they are the same, because they have to be the same. All right, so it means our cash flow is balancing, everything is sorted, we are happy with the work right there. All right, everything is fine, everything is okay, we've done our work, and we are happy because everything seems to be sorted, right? So thank you for watching, and do not forget to subscribe, like, and share, And note that we also offer private tutorials, whether online, whether face-to-face, depending on the package that you want, whether you want an online or face-to-face and how you want to do it, right? So thank you for watching once again, and salute.